Let's dive into a core topic: the role of lenders, both commercial banks and private debt funds, in financing infrastructure projects. Whether you work in investment, credit, or legal advisory, understanding how lenders approach risk, structure transactions, and monitor assets is essential. Let's get started. In most project finance transactions, the lender's involvement begins with the capital structure. A typical stack is composed of equity from the sponsor, usually ranging from 10% to 40% of total project cost, depending on sector and risk profile. Senior debt, the main source of funding, provided by banks or private debt funds. This debt is secured, long tenor, and repaid exclusively from project cash flows. Sometimes, junior debt or mezzanine financing, which sits between equity and senior debt. It offers higher returns due to its subordinated nature and can help optimize the sponsor's equity contribution. Lenders focus intensely on ensuring the senior tranche is sized based on robust cash flow coverage, usually through ratios like the DSCR, LLCR, or Project Life Cover Ratio. Let's make this concrete with a simplified sources and uses structure for a 50-megawatt onshore wind farm. For the uses, you may have EPC and turbine supply, €55 million. Then, development costs, €3 million. Then, financing fees and contingencies, €2 million. So, total, €60 million. And for the sources, you may have senior term loan, €48 million. Then, mezzanine loan, €4 million. Finally, sponsor equity, €8 million. This structure illustrates the classic leverage used in renewable energy transactions, where lenders finance the majority of capex as long as the project demonstrates predictable revenue streams. For example, under a PPA or CFD, what lenders need to assess a financing opportunity. Before committing capital, lenders perform a deep analysis built around three pillars. First, understanding the project. Sponsors must provide a detailed presentation of the asset and its technology, the contractual ecosystem, EPC, O&M, PPA, land rights and permits, the project company and its governance structure. Then, lenders rely heavily on third-party advisors and due diligences to challenge assumptions. This usually includes technical due diligence, energy yield or traffic studies, environmental and social assessments, legal due diligence covering permits, contracts, and corporate structure, insurance reviews. These reports form the backbone of the lender's risk assessment. Then, the financial model is the central decision tool. Lenders examine base case and downside scenarios, sensitivity analyses, debt sizing outputs, covenants and reserve accounts, waterfall mechanisms. Ultimately, lenders are asking, does the project generate enough cash to repay debt under reasonable stress scenarios? Then, post-closing. What happens after financial close? Once the loan agreements are signed and funds are dispersed, lenders continue to monitor the project through the entire tenor of the loan. This includes construction monitoring, with independent engineer reports validating milestones before drawdowns. Operations phase monitoring, including quarterly reporting, covenant testing, audits, and compliance certificates. Accounts oversight, ensuring adequate liquidity for debt service or major maintenance. Waivers and amendments, which become necessary if the project faces delays, cost overruns, or operational underperformance. Private debt funds, in particular, can offer more flexibility in negotiations, while banks may offer lower margins but tighter covenant frameworks. Beyond providing capital, lenders shape the transaction through structuring discipline, ensuring risks are allocated to the parties best able to manage them. Market confidence, bankability is often a signal to other investors. ESG integration. Increasingly, lenders impose environmental and social standards as a condition for financing. Pricing efficiency, competitive debt processes can significantly improve sponsor IRR. In short, lenders play a crucial role not just in funding infrastructure, but in defining its long-term sustainability and performance. That's it for today's deep dive into the role of lenders in infrastructure project finance. If you found this episode valuable, don't hesitate to like, subscribe, and share it with colleagues in finance or law. Thanks for listening.